Dear students, in previous video we have studied about credit analysis, economic feasibility test, that is return from investment, risk bearing ability and repaying capacity. Now we will discuss 5 C's of credit and 7 P's of credit. Next to 3 R of credit, the other important tests applied to study the economic feasibility of the proposed investment activity are 5 C's of credit, that is character, capacity, capital, condition and common sense. When we study about character, the basis for any credit transaction is trust. Even though the bank insists upon the security while leading a loan, an element of trust by the banker will also play a major role. The confidence of an institutional financial agency on its borrower is influenced by the moral character of the borrower, like honesty, integrity, commitment, hard work, promptness, etc. Therefore, both mental and moral character of the borrower will be examined while advancing a loan. Generally, people with good mental and moral character will have good credit character as well. When we study about capacity, it means capacity of an individual borrower to repay the loans when they fall due. It largely depends upon the income obtained from the farm. That is, whatever be the income, it generates capacity. The third C is capital. Capital indicates the availability of money with the farmer borrower. When his capacity and character are proved to be inadequate, that the capital will be considered. It represents the net worth of the farmer. It is related to the repayment capacity and risk bearing ability of the farmer borrower. The fourth C is condition. It refers to the condition needed for obtaining loan from financial institutions, that is, procedure to be followed while advancing a loan. When we talk about 5C, fifth C, that is common sense. This relates to the perfect understanding between the lender and the borrower in credit transactions. This is in fact prima facie requirement in obtaining credit by the borrower. Now we talk about the 7 P of farm credit, or we can say principles of farm finance. The increased role of financial institutions due to technological changes on agriculture front necessitated that evolving of principles of farm finance, which are expected to bring not only the commercial gains to the bankers but also social benefits. The principles so evolved by the institutional financial agencies are expected to have universal validity. These principles are popularly called as 7 P's of farm credit, and they are mainly principle of productive purposes, principle of personality, principles of productivity, principle of phase distribution, principle of proper utilization, principle of payment and principle of production. Principle of productive purposes. This principle refers to that the loan amount given to farmer borrower should be capable of generating additional income based on the level of the owned capital available with the farmer. The credit needs vary. The requirement of capital is visible on all farms but more pronounced on marginal and small farms. The farmers of these small and tiny holdings do need another type of credit, that is consumption credit, so as to use the crop loans productively. In spite of knowing this, the consumption credit is not given due to due importance by the institutional financial agencies. The principle conveys that crop loans of the small and marginal farmers are to be supported with income generating assets required through term loans. The additional incomes generated from these productive assets add to the income obtained from the farming and thereby increases the productivity of crop loans taken by small and marginal farmers. The examples Relevant here are loans of dairy animals, sheep and gold, poultry, birds, installation of pump set on group action, etc. Second P of principle of personality. The second P, that is principle of personality. The third R of credit are sound indicators of credit worthiness of the farmers. Over the years of experiences in lending, the bankers have identified an important factor in credit transactions, that is trustworthiness of the borrower. It has relevance with the personality of the individual. When a farmer borrower fails to repay the loans due to the crop failure caused by natural calamities, he will not be considered as willful defaulter. Whereas a large farmer who is using the loan amount profitably but fails to repay the loans is considered as willful defaulter. This character of the big farmer is considered as dishonesty. Therefore, the safety element of the loan is not totally depend upon the security offered but also on the personality of the borrower. Moreover, the growth and progress of the lending institution have dependence on this major influencing factor, that is personality. Hence, the personality of the borrower and the growth of the financial institution are positively correlated. The third P, that is principle of productivity. The principles underline that the credit which is not just means for increasing production from the enterprise alone, but also it should be able to increase the productivity of other factors employed in the enterprise. For example, the use of high yielding varieties in crops and superior breeds of animals not only increases the productivity of the enterprise but also should increase the productivity of other complementary factors employed in the respective production activities. Hence, this principle emphasizes on making the resources as productive as possible by the selection of most appropriate enterprises. The fourth P, that is principle of phase disbursement. This principle underlines that the loan amount need to be distributed in phased so as to make it productive, and at the same time bankers can also be sure about the proper end use of the borrowed funds, that is, for example, loans for digging wells. The phased disbursement of the loan amount fits for taking up of cultivation of perennial crops and investment activities to overcome the diversion of funds for unproductive purposes. But one disadvantage here is that it will make the cost of credit higher. That is why the interest rates are higher for term loans when compared to the crop loans. The fifth P, that is principle of proper utilization. Proper utilization implies that the borrowed funds are to be utilized for the purpose for which the amount has been lent. It depends upon the situations prevailing in the rural areas, which the resources like seeds, fertilizers, pesticides, etc. are free from adulteration. Whether infrastructural facilities like storage, transportation, marketing, etc. are available. Therefore, proper utilization of funds is possible if there exist suitable conditions for investment. The sixth P, that is principle of payment. This principle deals with the fixing of repayment schedules of the loans advanced by the institutional financial agencies for investment credit advance to irrigation structure, tractors, etc. The annual repayments are fixed over a number of years based on the incremental returns that are supposed to be obtained after deducting the consumption needs of the farmer. With reference to crop loans, the loan is to be repaid in lump sum because the farmers will realize that the output only once. A grace period of 3 to 3 months will be allowed after the harvest of crop to enable the farmers to realize reasonable price for his produce. Otherwise, the farmer will resort to distress sales. When the crop fails due to unfavorable weather conditions, the repayment is not insisted upon immediately. Under such conditions, the repayment period is extended besides assisting the farmers with another fresh loans to enable him to carry on the farm business. The seventh P, that is principle of production. Because of unforeseen natural calamities striking farming more often, institutional financial agencies can not keep away themselves from extending loans to the farmers. Therefore, they resort to safety measures while advancing loans, such as insurance coverage, linkage credit with marketing, providing finance on production of warehouse receipts, taking sureties. Banks advance loans either by hypothecation or mortgage of assets, credit guarantee. When banks fail to recover loans advanced to the weaker sections, Deposit Insurance Credit Guarantee Corporation of India reimburse the loans to the lending agency on behalf of the borrower. So we can say the principles of credit are suggestive measures to farmers in taking a wise decision. Thank you.